And so they can pretty much tighten up until they get to the point where it causes some sort of disorder in the bond market, and then they usually have to put out a fire, and then they have choices where they can go from there. They can either, they can go all out liquidity bazooka like we saw in March 2020, or they can try to do more targeted interventions and try to keep some level of tightness while still monetizing and liquefying, that sovereign bond debt issuance. Generally, whenever a country gets over 100% debt to GDP, it starts to be the case that historically it's very, very unlikely that those bonds over the very long run are going to be paid back in purchasing power terms. And so that's where you get that more inflationary type of response, that financial repression, that more rapid increase in the broad money supply. It was after you had significant inflation relative to those interest rates. You had a period of financial repression, significant real losses in treasuries and cash. And we're kind of seeing a similar environment now where, if you go back to the 1940s, I mean, that was a period where the Federal Reserve pretty much completely lost its independence.
Well, I don't know how you get all your work done.
That's been the constant. Yeah, I've actually been, it's been hard. I've been trying to cut down on interviews, trying to cut, I mean, I had to say no to most conference invites and offers.
That makes us even more grateful to have you today. Thank you.
So the topics are interplay of monetary and fiscal policy over the last century and over time, concept of financial repression, central bank credibility and the future of the monetary system, and take it away.
Yeah, so first of all, thank you for having me. And, I think the biggest picture thing I focus on over the past few years is this concept of the long-term debt cycle. And that was originally popularized by Ray Dalio. And one thing I did was, I would see his charts and see his explanations, and I said, okay, that actually answers some of my questions. But I want to go in and determine, is this accurate, and can I explore this from other angles, and how can I quantify this in other ways? And so I went, I spent a lot of time going through very old data sets and reconstructing all sorts of historical, fiscal, and monetary, different ways of measuring debt and monetization and inflation and, fiscal deficits, things like that, interest rates. And I built this big data set that I then used, which formed my macro thesis that has been extremely helpful over the past few years, which is basically extending and deepening that long-term debt cycle thesis. And the short version is the idea that, we always think of these short-term business cycles, these 3 to 10 year credit expansion and contraction cycles. And I think the important insight there is that because policymakers can come in and respond to when there's a credit contraction, they can cut interest rates, they can do fiscal stimulus, depending on if we're talking about fiscal or monetary authorities. The point is they purposely kind of short circuit that deleveraging process, and then they try to get that credit growing again. And generally what happens is when you string a bunch of those together, instead of like a sine wave of credit expansion, you end up with like an upward sloping sine wave. So you keep getting higher and highs in terms of debt GDP, and then you get lower and lower interest rates because now there's more debt in the economy and there's kind of that more downward pressure on the rates. And so you keep kind of building up more and more debt. And so that's what you can call the long-term debt cycle. It goes through multiple cycles over multiple decades. And the problem, of course, happens when you get so much debt in the system, and then you run into the zero bound, or in some countries even mildly negative interest rates, and then there's really no further to go to allow that engine to keep going up. And then you start to get, this happened in 1929, into the 30s, and it happened again during the global financial crisis. If you look back in terms of financial metrics, those were very similar. Like in terms of, for example, how much bank loans there were in the economy compared to the size of the monetary base, right? So you're basically your multiple on different types of money compared to deeper into the stack, and how much credit risk you're taking on when you have that type of levering. Combined with, of course, speculation, either on stock market or houses, depending on the environment. And when that all unwinds, that's a private debt bubble that's popping. It's very disinflationary. Money's being destroyed because loans are being defaulted on. And you start to get kind of a fiscal response, right? So both in the 30s and in the 2000s, you had these ongoing fiscal and monetary responses to try to deal with that. And my observation was, a decade later is when you run into the other side of that crisis, right? So that part of the crisis is the private debt bubble, the disinflationary deleveraging crisis. But when you put all that debt onto the sovereign balance sheet, when you monetize it, when you go through this process, that has a number of consequences, right? So one is you again, like I said, you put it all on the sovereign level, but you also in both the 30s and the 2000s, you had periods of rising populism, right? So there's more and more discontent. There's basically this kind of a widespread understanding that the economy is not functioning well, and when they run into the next crisis, in the 40s, it was a lot of that populism turned into war, obviously, and here we had a very kind of still levered environment, high populism, slowing economy, ran into COVID, and now we have war. Both those environments, you generally get very, very large fiscal responses, right? Because it goes up to that level. And that's where you get that more inflationary or stagflationary type of situation. And so I've been making a lot of parallels between the 2020s and the 1940s, and as well as the 2010s to the 1930s. And unfortunately, that does continue to play out. And in some cases, it has even become more literal, now that there's some degree of kinetic war happening.
Can this credit expansion, this debt expansion, does it wind up when you inflate it away? Is that the same thing as credit contraction?
It's a different phenomenon because credit contraction on its own is more disinflationary. That's kind of what we've seen in Japan, for example. They've had money printing at like the sovereign level, but they've had significant deleveraging at the corporate level, both in terms of increasing their cash allocations and decreasing their debt levels. So they've been a lot of it has gone towards net debt reduction, and that's been an environment of low money supply growth, and generally stagnation. Same thing for like the 2010s and the 1930s. You had a reduction in the amount of debt relative to GDP among the private sector. And so that's generally a more disinflationary environment because you have low demand for things, or at least slow growing demand compared to the prior trend. And the issue is that, one is that commodity cycles work themselves out over time. So those are environments of say, commodity abundance and low demand. And then the problem is over time, you work through those reserves that you've built. There's not a lot of, not necessarily a ton of new capex coming online. Demand is slowly increasing over time. And eventually you run into the next commodity undersupply cycle, which is generally a more inflationary cycle. And then the problem is you're now running into that environment when you have super high sovereign debt level, right? So you have that tension between you're supposed to raise interest rates when you have inflation, but now you have over 100% debt to GDP, and you have a very highly leveraged system, especially when you look out in parts of Southern Europe, you look at Japan, as well as here in the United States. And so that's where you get that more inflationary type of response, that financial repression, that more rapid increase in the broad money supply, right? So for example, in the aftermath of the global financial crisis, if you look at a chart of M2, broad money supply, nothing looked unusual about it, because you had some money being destroyed from loan defaults, and then you had some fiscal response to shore that up, and they roughly balanced out. So you had roughly normal broad money supply growth, whereas in this type of environment, and in the 1940s, you had that huge increase in broad money supply because you had very, very large fiscal monetized fiscal deficits, which is generally a much more inflationary type of environment.
So governments need to debase the currency in order to get out from under the massive credit expansion that certainly that's happened lately. That certainly creates a conflict between governments and central banks, and that's where we get into this idea of financial repression, right?
If you go back to the 1940s, I mean, that was a period where the Federal Reserve pretty much completely lost its independence for the better part of a decade, where it just capped yields, much like what Japan is doing now. In the 1940s, the Federal Reserve capped long duration treasuries at 2.5%. They capped the short end of the curve at near zero. And that was despite the fact that you had an average of about 6% inflation in the 1940s. It spiked as high as 19%. They were still holding rates in that like 0 to 2.5% band. Towards after the aftermath of the war, that's when you eventually separated them. That was after you had significant inflation relative to those interest rates. You had a period of financial repression, significant real losses in treasuries and cash. And we're kind of seeing a similar environment now where, the Bank of Japan's holding rates very low, despite the fact that inflation is above their target. You have, the Eurozone's dealing with very high inflation, but they're still trying to manage spreads for those southern countries. Because you have a fiscal problem and a debt problem. We see the Bank of England come in, they're supposed to do QT. they had to cancel their the balance sheet reduction speech and start just kind of doing 2 weeks of QE, despite the fact that inflation's 10%, because they're trying to have not their bond market get disorderly and break all the pensions. And we're seeing kind of cracks in the U.S. Treasury market. We'll see how that develops. But essentially, yeah, one thing that characterizes the end of a long-term debt cycle is a loss of central bank independence, and that kind of forced blend of monetary and fiscal policy. Because the reason we think of government bonds as risk-free is because we know when push comes to shove, they support them as needed. And so if you have generally whenever a country gets over 100% debt to GDP, it starts to be the case that historically it's very, very unlikely that those bonds over the very long run are going to be paid back in purchasing power terms. They're going to be defaulted, restructured, or inflated in some way. Now, if it's an emerging market where some of the debt is not in their own currency, that's where they're more prone to nominal defaults or restructurings. Where in a developed country where the liability is their own currency, that's usually when you have historically things like gold depegs or financial repression holding rates below inflation, where you essentially restructure or partially default in that way, where you pay every currency unit that's owed, but over the lifetime of those bonds, those bondholders do get a haircut on their actual purchasing power.
I guess your work has suggested recently that the Fed, if they're going to lose the battle against the U.S. government for debasement of the currency, it's more likely the Fed's going to be reacting to some sort of a crisis rather than meeting its inflation objective. Is that fair to say? And
I think in the long run, I think right now they're really focused on their inflation objective. But a good example is actually the repo spike of 2019, right? So they were, they were reducing their balance sheet, and then out of nowhere, or seemingly out of nowhere, because some of the analysts I was following were focusing on this ahead of time. But you had a spike in the repo market, and that seemed like not a big deal at the time. But that was the financing that was used by hedge funds, for example, to buy treasuries, because at the time, FX hedged treasury yields were negative. So Japan stopped buying, a lot of European investors stopped buying treasuries, particularly T-bills. And so you had a supply glut of T-bills relative to buyers. And a lot of that financing was being now shifted to hedge funds with repo. And the Fed had to come in, and first they did repo intervention, and then they actually had to go a step lower into the problem and start buying T-bills, despite the fact we weren't in a recession. And they didn't really have, it was challenging to communicate about that. And that's an example where, within the framework of how regulations are structured around, how much treasuries banks can buy, where all the pockets of finance are, there's only so much that could be done. And so they had to come in and kind of, just cut their own plans short to, keep financial order intact. Kind of like how the Bank of England, they had to step in out of nowhere to buy government bonds. And so it's generally the case where, they don't even have to make an active choice to do it. It's more like if the sovereign bond market goes disorderly for any reason at all. It happened in the U.S. Treasury market in March 2020. It happened in the gilt market just recently. That's when they step in. And so they can pretty much tighten up until they get to the point where it causes some sort of disorder in the bond market, and then they usually have to put out a fire, and then they have choices where they can go from there. They can either, they can go all out liquidity bazooka like we saw in March 2020, or they can try to do more targeted interventions and try to keep some level of tightness while still monetizing and liquefying, that sovereign bond debt issuance, or finding balance sheets to put them.
What do you think the chances are that the Fed keeps tight until inflation is fine, and that it plays out the way they would like it to without having to respond to some crisis?
So I think unlikely, but I would be specific about timing, in the sense that I've described this as like holding a beach ball underwater, right? So as long as we're not solving the structural energy problems, right? It's not just the war in Europe. It's really, this kind of lack of capex in energy over the past 5 years or more, as well as some capacity limits of OPEC. That they're kind of near the top end of how much they can produce. And so there's kind of not a lot of new supply with high visibility coming online, and there's not a lot of encouragement for those companies to get it online. And so I think we have a supply side issue here. As we also have kind of the partial end of globalization, right? So we had this like big disinflationary force from the opening up of China, tapping into that cheap labor pool. Now we have rising geopolitical tensions, things like that. So even if that doesn't all unwind, just the fact that it's no longer going in one direction takes away a disinflationary force. So more wage pressure, more energy pressure, and so I think that essentially what they can do is, if they cause, say, enough of a recession, it's possible they could temporarily get inflation back down. But then when you let go, like you're holding a beach ball underwater, you let go, it pops back up. Until they actually solve some of these supply side problems, which are out of the purview of the Fed,
Yeah.
I think inflation is just ready to jump back as soon as you give it some degree of, if the dollar's not going straight up, if you're not being super tight, I think it's ready to return. So it's less about can they get it down. I think it'll be challenging, but it's possible. I think it's more like, can you get it down and then it's all good and you go back to disinflationary growth? I'd say no, not until you have a significant capex cycle in energy.
And you've written that energy is the source of a probably structural higher inflation rate going forward. So that would imply the Fed would have to kind of change their neutral number from 2 to 4 or something like that.
It's possible we'll see something like that, and of course that's politically, the optics aren't great on that. And so I think, right, if they polled people months ago and they were like, what are your biggest concerns? And they were like, well, inflation and gasoline prices, which is another way of saying inflation, and rent, which is another way of saying inflation. So there's a key mandate to go after inflation. I think if they are tight enough and they manage to uptick unemployment, they manage to suppress asset prices for long enough, some of that, I think, discontent starts shifting to economic, and then you have that more mixed bag. And of course, the other side is, even if they don't get that far, if they just have to jump in and do something similar to what the UK had to do for their gilt market, if they have to reliquify treasuries in some way, there's only so much tightness they can do. Because one thing I've highlighted is that as they tighten and as they strengthen the dollar, a challenge is that all these other central banks around the world, they start selling or at least not buying treasuries, letting them mature off their balance sheet, buying back some of their own currency to kind of, support their own currencies a little bit. And so you have that problem where the Fed's selling, or, the Fed's letting them mature off their balance sheet. So they're net sellers of treasuries. The foreign sector's net sellers of treasuries. And banks, due to SLR regulations, they can only hold so many treasuries. So the question becomes, who buy the biggest balance sheets are not really absorbing treasuries, and that historically has been a limiting factor. And of course, that limiting factor becomes more relevant once you get to the high debt levels that we're at now.
And I guess
this week, last week, we had the IMF World Bank meetings here in DC, and I attended a lot, and that was definitely the message. There was two messages. The Fed was out there, not at the meetings, giving their own speeches, talking about inflation, and we have to tighten, and the rest of the world was here saying, you're not going to be able to do what you're saying you are. You're going to blow up the global financial system.
Yeah, and it ricochets back into the U.S. because one is, all of that slows, and then all, say something like the 40% of S&P 500 revenues that come from overseas, they take a hit, especially in dollar terms, right? Because even if they don't take a hit, it translates into fewer dollars. And of course, if those other countries slow down, it's even worse. And then also if you have supply chain problems, things like that. And then number two, you have that, like I just said, the treasury selling problem. Japan has $1 trillion of treasuries. China has almost $1 trillion of treasuries. Switzerland has, $1 trillion of assets. To the extent that they, want to maintain some currency or, prevent disorderly currency devaluation, they can sell some of these assets. And that's one of the feedback loops that eventually causes disorder. And then that makes the Fed have to do some degree of cessation of tightening or reliquification, maybe before they, hit inflation targets, or maybe they hit them briefly, like I said, but then as soon as they get their hand off the beach ball, it comes back up.
You did a good deep dive this weekend on the treasury market and who are the buyers, and you just touched on who aren't the buyers. Who are the buyers, and what is the chances that you wind up with a real problem on the supply demand and rates get out of control? Talk a little bit more.
So I think, I think pension funds can be buyers. They can rotate into some of these, higher yielding treasuries, especially shorter term. As well as some investors taking bets on the longer end. They might think that this rally is overdone, or this sell-off is overdone. So rally and yield, sell-off in bonds. They might want to get into that. At a certain price, you do attract some types of buyers. But the problem is that the biggest balance sheets are selling almost mechanicalistically. They're not, the biggest balance sheets aren't selling because it's overvalued or that's not really a judgment of a price. They're selling for mechanical reasons, and you have much smaller balance sheets that are more price sensitive, more evaluative. So that's one is like pensions, retail investors, various funds, asset managers. So that's basically the other side of that, as well as if they have an option to lower the duration and issue more T-bills, and then they have basically reverse repos that they can suck liquidity out of and get that into the T-bill market. And it becomes a question if they want to go that route or not. The Treasury's already talked about doing potential buybacks of off-the-run securities. So that they have obviously options aside from the Fed. So the Fed can be super tight for a while longer if the Treasury is then kind of being more nimble about and being more flexible about the durations that it's willing to work with.
And I think you said there's $2 trillion worth of that in the system that can cushion against a problem in the near term. Is that right?
Yes, but they have to tap into it. The problem is that's 2 trillion that can really only go into T-bills. It can't go into longer durations end of the curve, and so that's basically a balance sheet they can tap into if they're willing to, shift issuance towards bills.
The credibility of the Fed is already damaged, probably central banks everywhere. What is the state of central bank credibility over the long run? What happens if it continues to erode? We're just talking about government sovereigns taking a greater role going forward, but where does this all lead? And and I suppose I'm heading towards the obvious question about this new currency, Bitcoin, and its role in the future if central banks lose credibility.
So I think one is we see polls over the past decade showing that most types of institutions are losing credibility. So whether it's the government, whether it's Congress, whether it's media, whether it's central banks, a lot of institutions among the public are rapidly dropping or very low levels now in terms of whether they respect them. And central banks, I think, have a particular issue because, like I said, that the worst environment for them is high sovereign debt combined with an inflationary pressure.
Yeah.
Because that's where I mean, you could put Paul Volcker there, for example, and there's only so much he can do. When he did what he did, there was 30% federal debt to GDP. Now there's 120, 130% debt to GDP. And so it's not necessarily who's running it. It's a problem of math. And then there are, of course, different ways to navigate that math. And I think one of the biggest challenges we faced, it kind of touches on the Cantillon effect, which is basically that the closer you are to the source of money, the better positioned you are. So it's normal that a larger entity has better access to credit, more liquidity in during a problem. That's kind of unavoidable. Whereas, if you also have this kind of flexible liquidity provision, we've had a history now during the global financial crisis, and then again in March 2020, the Treasury and the Fed are able to make liquidity available to the business sector, but it's much easier to do that quickly for the large entities, right? So you give them liquidity right, when everyone else is falling apart, whereas like the mom and pop shop, they have much more hurdles to get to in order to access that liquidity, and that's one of the I think the some of the more sophisticated criticizers of this model are basically showing that it's, when you have that super flexible system and yet you still have limitations on, it's easier to get money to those big pools of capital, that they feel like the system's not working for them, that it's really kind of working for the insiders, the well-connected, that just even if it's not intentional, even just the large institutions that just have those closer and it's easier to give them liquidity than, the long tail of small businesses. And so I do think, globally, that this system, of rates that are below inflation, of seemingly kind of picking winners and choosers, and a bad track record of forecasting inflation. The Fed never predicts a recession, for example, almost by definition, because they could feed it, right? And so it's almost like they can't predict a recession, even if they privately were correct. It's not something they can really say out loud. So it's inherently a politicized organization, which is generally not what you want, but that it's inevitable, even if the person's trying not to be. And so I think we are in a period of structural impairment of central bank credibility. And I think some of that's the fault of the central banks, and other parts are just, it's almost like inevitable when you get to the end of a long-term debt cycle, high debt, high inflation.
And so this new invention, Bitcoin,
Well, I think, I mean, it's interesting because that was the timing was interesting because it came out during the global financial crisis. But if you look back at the technological history, there was a long path of things being done ahead of that, right? So uh, you know uh, cryptographic money began to be of interest in the 1980s. Um, then it kind of ramped up in the 90s. By the late 90s, that's when you had proof of work was invented. Then you had, Nick Szabo propose, using that type of mechanism to make digital scarcity, right? To use that as some sort of like online collectible. You had Hal Finney come and kind of take those ideas and actually implement them. The problem is it was centralized, right? So you could kind of mint this little like collectible, but it was tied to a centralized server. And then Satoshi Nakamoto comes along, takes this existing train of things that were developed, and he said, well, okay, here's how I do it decentralized. And that was kind of the game changer, right? Because now you have both digital scarcity and it's not relying on someone's centralized server. And so I think for a lot of people, that's been appealing to them when they understand how it works, because they say, okay, instead of a closed financial system, right? So, you have to get permission to open a bank account. If you try to send a wire transfer they don't like, the bank can say, we're going to block this one, or what do you want to use this for? If you go to withdraw your money, they can say that's too much, or what are you going to use this for? And we have it pretty good here in the United States and other developed countries, but the problem gets worse when you look at the fact that people around the world are dealing with emerging market currencies. Many of them are dealing with authoritarianism. The banking system can be co-opted against them. For example, if in Nigeria, they would protest police violence, bank accounts frozen, turn to Bitcoin, right? And so I think there's a lot of appeal to people in a rules-based system. So Bitcoin's monetary does not change. We know out in advance how many coins there are going to be and when. You can pay your fee to get your transaction in the next block. You can pay a lower fee if you don't mind waiting. You can pay a higher fee if you want it in sooner. And it's very this mechanical, open network. And I think that does appeal to a lot of people around the world. And of course, there's challenges. There's volatility. There's competitors. There's regulatory uncertainty. And so there are things that push people away from it. But I think that there are people that are fed up with the current system and that are looking for alternatives, and that whatever one might think of the price of Bitcoin or as an investment, I think the underlying technical innovation is remarkable. So not just Bitcoin, but like I said, the couple steps leading up to it, basically figuring out how to, basically online, anything's copyable, or in digital realms, anything's copyable. And so the idea of adding scarcity into that digital environment, I think is a really powerful thing. And I think it's going to be a long-term theme that's going to be important.
Well, I guess part of the reason that gold was thrown out was because man couldn't control the business cycle if they let gold set the monetary value. And so they took back control over it. It feels like, for this 70, 80-year period or whatever it's going to wind up being, that there's going to be plenty of demand for some sort of a stability that's not controlled by man. And would you anticipate that Bitcoin is the most likely candidate? Are there other candidates? Talk about gold too, because I know you did a big report on that recently.
Yeah, so I mean, gold has served well as a long-term store of value, right? So if you look at currencies over the long run, the U.S. dollar supply M2 increases by 7 or 8% on average per year. Other developed, Swiss francs also pretty low. When you get to emerging markets, it's usually higher. Whereas gold's average supply growth is estimated to be around 1.5%. So you essentially have this more mechanical, much slower growing supply. So it's generally a harder currency. And it's not, there's no one that can just snap their fingers and debase it. Even when it spiked by an order of magnitude in price in the 70s, if you look at the supply, the percent increase of gold each year, it didn't change much. Even though you started to get a ramp up in new production, you also now had a bigger supply existing. So your actual percent increase, it just kept fluctuating like sine wave around 1.5%. If you show me a price chart, I wouldn't be able to tell you where the price spike was, because it's just that stable. The challenge with gold, and I would say part of why it inevitably failed, not just it was a choice for it to fail, but it had to fail, was that once humanity had telecommunications channels, right? Once we laid the undersea cables in like the late 1800s, so we have banks around the world that can talk to each other and update their ledgers. Now you have a situation where commerce moves faster than the underlying bearer asset. And so you have to abstract it, you have to centralize it so that those representations can move around at the speed of commerce. And once you centralize something, that gives policymakers the ability to sever the connection to it, right? So if people aren't custodying their gold, if it's all vaulted in banks, then increasingly central banks and sovereign reserves, it's very easy with a stroke of a pen to change that. Whereas I think what's interesting about Bitcoin is that it's basically got the the relative scarcity of gold and the speed of fiat. And then the biggest challenge is that because it's open source, anyone can copy it, anyone can make another one. So there's 20,000 cryptos. And the analogy that I've given there is that like, Wikipedia is not that much data. You could actually copy Wikipedia and rehost it. The question is, are you going to get any traffic? And the answer is no, we're not anywhere near Wikipedia's traffic because the things you can't copy are the fact that there's millions of links around the internet pointing to the real Wikipedia. And so they're top of the search engines. And of course, and then they have that big volunteer editor base. And getting that network effect to shift over to yours is just going to be a non-starter. And so Bitcoin's like that, where anyone can copy it, anyone can try to scam people. Some people are doing legitimate projects, like what if you make it faster? What if you make it more expressive? These are all trade-offs. And I think there's some interesting technology out there, but I think that there's nothing really on the radar that competes with Bitcoin in the sense that, most of what they do is they sacrifice some degree of decentralization. So they make it harder for users to run nodes, which means there's generally fewer nodes, a less decentralized network, but then that network can do more. Whereas Bitcoin is the one that deliberately makes all these trade-offs and says, we're going to sacrifice functionality, we're going to not be super fast, and the goal is to be as decentralized and secure as possible. And I think that's what people are looking for, at least when they're looking at longer term past kind of these cycles. I think that's the one that has the most interesting and kind of high probability of chance of continuing to be relevant cycle after cycle.
And so is it as an investable asset class, where do you think it stands now and where will it be and where does it belong to be?
So I've been making the argument for a couple of years now that, zero is probably not the right number for allocations, right? That I think that it's worth a non-zero allocation in most pools of capital where possible. And of course, the more conservative pool of capital, the lower position you'd have given the volatility. Whereas, in say the venture space or in younger investors that are very deeply knowledgeable about how it works and that maybe want to self-custody and actually use it for some of its other properties, I think you can ratchet up that exposure. But of course, you have to be willing to, as you've seen, tolerate these 70, 80% drawdowns that can happen, even though it's been historically a good performing asset class. And just to, I basically think we're at the phase where people have to make sure they understand how it works, because this is, like I've said before, it's been around for 13 years, which is half as long as the first browser, right? And so, this is not like super new technology anymore. This has clearly got sticking power, it's staying power. The conferences around the world for it are getting bigger, even though the price is very volatile. And so this is something I think that people have to make sure that they at least have a decent handle on and understand it, because it's not going away at least. And it also, then there's a question of stable coins, central bank digital currencies, smart contracts, there's all these other things that kind of spawned from it. And I think that in the 21st century, you want to be familiar with how this works, at least the high level, as well as the trade-offs that they're making relative to each other.
The adoption of Bitcoin over time has gone its different paths. The demand, how much of the demand do you think is going to come from central bank credibility problems?
So I think that depends on the period. Like when we saw when the Bank of England intervened in the gilt market, and we started, even prior to that, when you started to see these big sell-offs in the pound, there actually was evidence, like Masari put out research showing that there's a big uptick in Bitcoin buying from European and UK investors during that period of time. And so, right now we're in an environment where the Federal Reserve has a lot of perceived credibility because they're being super tight. Whereas other central banks, less so. There's actually a really good set of charts out there. If you look at global M2, denominated in dollars, so you take the dollar, the yuan, the euro, the pound sterling, the yen, let's say those, and you take that money supply and you redenominate it all in dollars. Um, if when that's going up very quickly in rate of change terms, Bitcoin is highly correlated to the upside. It's generally doing quite well. When that's going down, either because multiple currencies are no longer expanding, or because maybe they're still expanding, but the dollar is so strong that the dollar denominated value of those is flat to down, generally you have Bitcoin doing quite poorly. And so it's actually, so far, it's been one of the purest monetary debasement hedges, right? So it's not a CPI hedge, but it's actually like a hedge against global dollar value of M2 going up. At least that's what it's been so far. And so to the extent that an investor thinks that's going to happen, a Bitcoin allocation, I think, makes a lot of sense. Whereas when you expect the dollar denominated value of M2 to go down, essentially basically the dollar is being temporarily hard money, there's not a lot of demand for Bitcoin. And so that can deflate, bubbles can pop, all the leverage shops that build around it go kaput, and that cycle gets kind of blown out. All the speculators leave, the tourists leave, and you kind of start the next cycle. And so I think that whether or not Bitcoin's interesting depends on partially on your view of what dollar denominated broad money supply is going to do over a given period.
Very interesting. How about just the promise of Ethereum and the smart contract world for the future of finance?
So I think that goes back to you have to make trade-offs, right? So in order to add more code expressivity to that base layer, you generally increase the complexity of running a node, which puts it out of the hands of more people. It centralizes the network more. They've also wanted to make a lot of changes. And so what they've done is they put difficulty bombs, right? So that what makes Bitcoin interesting is that nobody can push updates onto you, right? So it's actually, it's kind of like its slow to change nature is a feature rather than a bug. Whereas in Ethereum, they wanted to go in the other direction and give developers more power so they could push updates onto users because they kind of had like kill switches in the existing network. And so they had to keep going back to developers in order to get the latest version. And so that's how they've been enabled to force more updates through the system. And of course, that's interesting, but also makes it somewhat more equity-like, right? So you're looking at that environment in a similar way that you would analyze, say, the Apple, ecosystem, or the Google Play ecosystem, right? These are more like ecosystem type of investments where there's still a decent amount of centralized control over the network. Whereas Bitcoin is it's more like Linux, it's more like open, it's more like it is what it is kind of. And so I kind of put them in two very separate camps. And I actually agree with Gary Gensler, where he's like, Bitcoin's a commodity. Everything else is kind of, or at least most other things are pretty close to the Howey test. Some of them more clearly pass it than others, and that they're more security-like in the sense that there's a somewhat centralized team that is working on it to purposely try to increase the value and usability of it. And then that puts you more in kind of the equity side of things, or you're kind of evaluating that on an ecosystem basis. And so I would just tell investors to outside of say Bitcoin and Ethereum, the track record's been very poor for cryptocurrencies, where you have a blow off cycle, and then that cryptocurrency is never relevant again, and then the next cycle it's another generation of cryptocurrencies. Bitcoin's been here for 4 cycles, Ethereum's been here for 2 cycles, and basically everything outside of Bitcoin does make certain trade-offs in order to, either if they're faster, if they're more expressive. And so I think that they're interesting, especially, the whole point of DeFi is that you can do, say, like leveraging or trading in an environment that is more open. But of course, that's in some ways that's regulatory arbitrage, right? And so that's regulators can clamp down on that quite a bit, especially because again, there's more centralized attack surfaces on most of those protocols compared to Bitcoin, which is more like it's more like BitTorrent, right? It's more like it's a much more decentralized network compared to something like, say, Napster, right? And so a lot of those other ones, they're on the spectrum of, say, BitTorrent versus Napster. A lot of them are more like Napster, where there's centralized attack surfaces that they can go after if they find that they're just doing regulatory arbitrage, or they're too much speculation, or they're violating securities laws. And so I just think there's risk around that.
If the regulators cure the problem of regulatory arbitrage, which they tend to do, after that, if on a regulatory basis they're on equal footing, how much more efficient is Ethereum-based smart contract finance to the current world, do you think?
I would say for the most, it's less efficient, right? Because the cost per computation is much higher, and so generally you'd only want that if you had some degree of decentralization. It's much cheaper just to run things on Amazon Web Server, and it's actually funny because a large number of Ethereum nodes run on Amazon, and it's because it's actually challenging to run a node because there's higher requirements for it than say Bitcoin, and a lot of people outsource their node running so that they're more just like users rather than operators. And so I generally I would say that the answer is not very efficient, and that's also opened up the door for these other competitors like Solana or Avalanche.
Yep.
They come along and they say, well, we're going to be more centralized and faster. I think one way to describe it is I describe all these platforms as federated computing, right? So if you take a typical centralized service like Amazon or to say Twitter, that's their database and you're interacting with it. You're using it. There's no way for you to audit it. They can shut out your account. They can do whatever. It's theirs, but it's highly efficient. Now, the question is, we know that's a useful model, right? Because it's very efficient. On the other hand of the spectrum, we have Bitcoin, which is about as decentralized as a database as you can get. And then in the middle, we have these more federated environments where it's not as decentralized as Bitcoin, but there are a number of kind of enterprises that are able to audit the real-time state of the ledger, the database. It takes kind of it's almost like a consortium that has to agree to update it. And the question is, does that add a degree of transparency and kind of separation of powers? Does that have a market value? Or, is that something that could be interesting? Maybe for stock trading, right? Maybe for these kind of settlement, if you want more instant settlement. So I think there's interesting technology there. I'm just not, I wouldn't have high confidence that the current versions of what we see are what is going to be around in 10 years.
Mm-hmm. In the current environment, what are the you on your website you run investment portfolios, and what do you think the best assets to own today are? What do you think about the current environment? What are your tactical and strategic thoughts?
So I think strategic. I mean, if I look out many years, I'm quite bullish on energy, quite bullish on many commodities, bullish on Bitcoin with careful position sizing. And bullish on energy pipelines, bullish on a number of high quality dividend stocks, for example, bullish on select emerging markets like India, Brazil, perhaps Mexico, basically these select emerging markets. I think those are places where you can put reasonable capital that there's not bubbles, and some of these are like anti-bubbles. In the tactical sense, I look, if there's one metric I would look at, it would be the Purchasing Managers Index, which is like a sine wave of economic acceleration or deceleration. Generally, in economic accelerating periods is when you want to take more risk. And generally, in economic decelerating environments is when you want to be much more careful with risk. And we've been in a declining PMI environment. And so I've been emphasizing things like healthcare stocks, pipelines, things that are not, maybe defense, things that are not super cyclical, that are also reasonably valued. And so my general view is while the Fed is tightening into a declining PMI, play defense. And that, of course, defense means different things for different portfolios, but whatever their risk model is, tilt defense. And if we do at some point get, a reversal in some of these policies, so you start to see PMI go up, you start to see the Fed pause or pivot, you see a liquefaction, you stop having global M2 in dollar terms go straight down, or at least rate of change go straight down. If you start to see that reverse, basically more liquidity, more PMI, that's when I want to press the risk button a little bit more and go back into the riskier side of some of the things I've mentioned.
And you think that is tilting right now, right?
Not well. So I think I think we're getting a bear rally in still a declining situation, right? So I think that purely from sentiment, everybody was bearish, and there's a lot of like put buying among retail, and so I kind of called for a decent probability of like a kind of a spike back up, and we got that Monday and Tuesday. Today's a little bit rougher, and so we'll see how much legs that has. Also, you could see the administration want to have just a functioning market going into the election, kind of similar to how they want as low oil and gasoline prices as possible going into the election. But I think that there's no clear signs of a structural reversal yet. There's no clear sign that the Fed's going to pause. There's no clear sign that PMI is turning up. And so I'm still generally defensive, but with a caveat that you don't want to get super bearish, because that's when, it's when it goes against you pretty hard.
Your thoughts on energy?
Yeah, so we can look at it from a demand and a supply side. So the supply side is that ever since the oil price collapsed in 2014, there's been very weak capex. A lot of the U.S. shale growth over the prior decade was cheap money and pensions being happy to finance debt and equity issuances. A lot of those drillers were free cash flow negative. It was like drill, 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 just keep growing. Kind of like growth stocks were recently, right? So, the stocks saying we're not profitable, but our sales are great. We're going to keep issuing more shares. You had that back in the oil patch last decade. And when you had the collapse in oil price and you have an increase in ESG mandates, you have a lot of these pools of capital that either not investing in energy or they're saying, I want you to be more disciplined. I want you to focus on dividends and buybacks and strengthen your balance sheet. Only drill when there's a really low hurdle rate, like a high hurdle rate. I mean, only drill when it's super obvious to drill. Don't drill at all costs. And so we've been in this much more constrained environment of capex spending. And so, we kind of after the second washout, which was the whole COVID lockdown, we collapse in demand that bankrupted a number of more firms. The response after that is, we've had this uptick in energy, but there's really no supply response, and there's only so much that can come online quickly, and they're still being rather disciplined, and there's not really a lot of new reserve space is ready to move into production anytime on the horizon, other than around the margins. And so right now we have the U.S. holding oil down with the SPR, the Strategic Petroleum Reserve drawdowns. They can only last so long. We also have recurring Chinese lockdowns, which are taking out a lot of driving and jet fuel and production, things like that. And then we still on the side we have the long-term arc of more emerging market demand for fuels. The growth of India, the growth of Indonesia, the growth of parts of South America, for example, still growing their demand, parts of Africa. And so I think we're in an environment where in an inherently tight energy space until we have more capex. And then, of course, the war added frictions to all of this, right? So when you shut off natural gas to Europe, they have to tap into the LNG market more, which raises prices for everyone. There's only so much capacity. Then they also can turn to substitutes. They can burn more oil. They can burn more coal. So then the price of those things gets pushed up. And there's no quick fix to add all this new infrastructure. And so with Europe, I'd be careful about looking. So natural gas prices have been extremely volatile, obviously. So even though they just crashed, they still crashed to a much higher level than, say, North American gas prices. And they're still going into this winter, right? And so they've had a pretty warm season for a little while now. They've been able to build up their stocks. We still don't know what the winter is going to look like in terms of temperature, which can affect how rapidly they draw down their natural gas reserves. And there's really still no, on the horizon, ability to get a lot of energy to Europe. And so my expectation is we're going to see a lot of volatility over the medium and long term. I'm not really a buyer of European natural gas price. I think in the long term, we're going to see more LNG capacity, and therefore the arbitrage between North American gas prices and European gas prices is going to, shrink, which can push up North American gas prices, all else being equal, and should get a lid on some of these, European gas. In addition, we've had demand destruction in Europe. So a lot of energy intensive businesses have had to shut down due to untenable electricity prices. And so that also helps alleviate. So when you see the natural gas price going down, it's partially good news, but then you're like, oh, well, a lot of fertilizer companies shut down and aluminum companies shut down. And so that can have ramifications a year from now, 2 years from now, kind of like, supply chain type of disruptions for some of these other things. So the goal is, the goal we're optimizing for is not to get natural gas prices down in isolation, is to get that down while that demand is still in line. Right. And so that's, I think, the longer term challenge. And that's the part that's a multi-year fix. So long story short is I'm structurally bullish on energy for years, while, dealing with the fact that there are periods of demand destruction, there is volatility, there is political interest to push it down for periods of time. But I'm generally structurally bullish on the energy sector.
We'll see if the Biden administration will be able to buy its oil back at $67 to $72.
I'm skeptical, and even if they did, I mean that kind of sets somewhat of a floor, and a lot of these companies are still profitable at that level, And even though a lot of energy stocks their prices don't fully reflect the amount of cash flows I think they're getting. There's still just not a lot of inflows. There's still a lot of pools of capital that can't buy them. And so if you're a more flexible investor, I think a lot of them are long-term attractive at these levels.
Do you see them, Lynn?
Yes, I see the
I'm
Q&A.
interested in, yeah, so why don't you go ahead and.
Okay, so one of them says, Lynn, do you still like Gunner ETF for energy commodities? The short answer is yes. I view it as one of the more straightforward ways to play energy. Basically, it's an ETF that consists of large producers, and they divide it into energy, metals, and then agriculture and things like that. So you have a pretty diversified exposure. I also like to use energy stocks or energy ETFs because I like to make it even more energy focused than Gunner is. But again, it's a you have to be able to understand the volatility. The challenge about commodity producers and commodities is that over the very long arc of time, they're generally poor performers compared to other sectors. But then, every once in a while, they crush everything else. And so I think that the 2020s are an environment where commodities and commodity producers are likely to do well. We have to be careful about overstaying your welcome by the time you get into a full-on capex cycle.
Yeah, you want, yeah, all the commodities, when you're in the profits, start thinking about taking
Yeah.
profit.
And so next question, Lynn, previously we were big holders of BAM, that's Brookfield Asset Management. What are your thoughts on BAM and this type of company? Thanks. So I think, it got a little bit more mixed once we had the office space shakeup, right? So quick work from home thing. Brookfield does own a lot of office space, a lot of, prestige skyscraper type of assets. But it's actually the rest of their portfolio that I like quite a bit. So, they're big into infrastructure. They're big into renewable energy, and they're pretty counter-cyclical in the way they go about things. So I've still been long that company. I've just been less, kind of making it less of a core position because it's more uncertainty around some of their flagship properties. But I think I think that they're probably going to do pretty well in the coming decade. And I think it's structured in such a way that it's pretty good for shareholders. Another question is, along with possibility of spread of kinetic wars, is there possibility of deeper financial war, currency war? If so, how are you positioning for it? So I think, yeah, I mean, you can have cyber war. You can have, changes in, we've seen financial war already. I mean, as Russia invaded Ukraine, a lot of countries shut off their FX reserves. And so that was a big cost to them. And you cut them out from SWIFT, you cut off their reserves. So that's a form of financial and currency war. And then if you have, right now we have a number of countries trimming their treasuries in order to backstop their currency. If you were to have, for example, a breakdown of relations between the United States and Saudi Arabia, they could dump more of their treasuries and buy other assets if they wanted to go that route. So I do think we have to be on the lookout for more diversification among reserve practices, as well as just heightened risk of targeted attacks on other countries' financial systems, targeted attacks on cyber. And I think we're kind of headed towards a little bit more decentralized world in this sense. And so, I mean, one of the defenses I think is gold and Bitcoin, as well as just having an emphasis on good, high quality, scarce cash flow producing assets like pipelines or dividend stocks and things like that that are resilient to these types of things. Another question is, could you talk more about risk parity? I mean, that's a broad question. I mean, I think that risk parity so that was the idea of, you go long stocks and bonds, you overweight bonds and you leverage them instead of being, focused on equities. I think the risk there is that when you're no longer in a structurally declining interest rate environment, that's just generally not a strategy that's super attractive. I think that if you look at a typical portfolio, risk parity portfolio or a 60-40 portfolio, it's a disinflation portfolio. It's a portfolio that wants low commodity prices so that other things can grow and do well. And so in an environment where that's not happening, I think that one way to hedge that, a way to hedge that type of structurally disinflationary portfolio is to own some segment of your portfolio that benefits from inflation, that benefits from disorder. And that can be a broad mix of commodity producers and hard assets and things like that. And relative to its correlation for oil prices or its movement to interest rates. I actually view pipelines less so about either of those things and more about valuation and risk, right? So right now, when you're entering a declining PMI environment, I'm worried about cyclicals. Just like announcements like FedEx can come out and lose 20% in a day because they undershot earnings and expectations. Whereas pipelines are, I don't think we're going to use less fuel oil, at least not not much. Pipelines have been washed out in the last two, in the 2014 oil bear market and then the 2020 event, that whole space was washed out. And so the ones that remain are generally not super levered, decent payout ratios, low valuations, and high distribution yields. And, a lot of them do K1 forms. And so for tax reasons, a lot of foreigners actually, some tax changes happened. They had to divest from them. You don't have like retail Robinhood investors speculating in them, right? So just kind of a dearth of capital in them. And that actually makes for a long-term opportunity for people that want to hold them for 5+ years and, collect those distributions and own something that's inherently scarce. Something that's, like we talked about all these energy and, it's not just producers, it's also transporters, kind of a dearth of capital in new transportation infrastructure. And so I think that owning the underlying assets that now, due to inflation, just had now they have higher replacement costs. I think that's a pretty attractive situation.
How do you like 0 to 1 year treasuries?
So if I'm risking, I think that's, those types of cash equivalents, right? So very short-term treasuries, I think is an attractive place to be. Now, if you get a big risk rally, obviously that's not going to feel great. Is also, even as high as their yields are, they're lower than current inflation. They're higher than forward inflation expectations, but they haven't been very accurate as of late. And so I think that there's an opportunity cost from being in there super long, but I think that as long as we're in a declining PMI environment, now that those rates are this high, I think it's actually pretty attractive if you're risk averse. And then the last one, Highland Bitcoin. Do you have any concerns about the long-term outlook for security of the network with the block reward going meaningfully lower into halving cycles? How will miners be incentivized to secure the network without significant price appreciation or network fees? So number one is 2 cycles is 8 years, or depending on what point you're measuring it from, so you can call it 6 years. If Bitcoin doesn't appreciate significantly in 6 years, that's obviously a problem for the network. The short answer is I'm not, my base case is not to be super worried about the long-term security of it, because the way we can characterize this is that Bitcoin has limited block space, and that's by design, because that goes back to my point about trade-offs and decentralization. They want to keep the bandwidth low so that it's easy to run a node, and so there's limited block space, and the network, depending on how you measure it, can only process it actually processes almost exactly the same number of transactions per year as Fedwire. Which is, about 7 transactions per second, which is, and you can do more than that if you batch transactions. So you can get up to maybe 10 transactions a second if you batch them. So you have like say 2 outputs or 3 outputs or 5 outputs and one input, like an exchange, say sending transactions out to multiple withdrawals with one batching transaction. So, you can call it 300 million. So if you had rough numbers, if you had 30 million people that want to make 1 transaction per month on the Bitcoin network, that more than fills up the whole block space, right? And so it's really a question of adoption. If Bitcoin reaches a high level of adoption, especially when you add things like the Lightning Network and you add ecosystems above it that allow for rapid transfer of Bitcoin that have to then go and settle down onto the base layer, then I don't think there's going to be a problem with overall fees. On the other hand, if Bitcoin at some point does become a stagnant chain and users stop growing, the user base stays flat, the block subsidy goes down, then the network over time becomes more vulnerable to 51% attacks. It's still it's improbable anytime in the near future, but the longer that stagnation were to occur, the more risk there is. So I think it's more of an adoption question and less of a design question personally.
Well, Lyn, thank you very, very much for your time. And I'll speak for the audience and say it's very valuable for us all.
I appreciate that, and thanks for having me. And hopefully I was helpful to people.
Absolutely. Thank you very much. Take care.
Bye.
Thanks, everybody.